That's how he first came to my attention. Jan Hatzius has gone on to acclaim at Goldman Sachs, not only running economics, but providing a view over investment research for the acclaimed firm. And we're thrilled he could join us today in our studios. Jan, I want to go right to the time continuum. Our Matt Bessler's really looking this as well. The x-axis out for any Fed chairman is always a challenge. What's the challenge for Chairman Powell right now as he looks out to 2023?
Well, I think there is a number of decisions that have to be made before that. When do they start to taper QE? Mm-hmm. They've said that they are not going to hike rates until that process has concluded, or at least strongly implied it. And that's also going to then determine what do you think when rates are going to start rising. At the moment, as you know, the dot plot is basically saying no hikes until the end of 2023. Right. But that's going to be on the table today, and I think it's a close call. Our best guess is that they stick with what they're with the message they're sending, right. But it could move forward.
There's your exclusive banner, folks. Hatzius predicts boring meeting. Okay, forget about that. It's Latin. It's ex ante. It's ex post. After the fact. Our Matt Bessler with a really important question. Maybe he'll be in the press conference as well. Matt Bessler making very, very clear that this is about the present base effect analysis versus the truly ex post inflation expectation game. Which is it? Is this analysis of base effect dynamics, or is it truly traditional Fed analysis of inflation expectations?
You mean what happens in 23?
What happens in 23? The mystery of how we get out there to this in this new theory.
I think that's going to be driven more by what you think about how tight the labor market is, and really the traditional stuff. The near-term inflation increase is partly base effect, it's partly reopening effects, and of course it's these bottlenecks which Michael just talked about.
Jan, before we get into just the granularity of inflation, I want to understand the granularity of tapering. People talk about it as though it's a monolith. And yet, is it, as Michael Collins said, the Fed getting to zero, getting to no bond purchases at all before they hike rates?
That's our assumption. I mean, they haven't said that explicitly, but I would guess that they're going to get to zero, and then there will be some time that will elapse before they start moving rates higher, and obviously that's going to depend on the data. But I would be surprised, though not maybe shocked, but surprised if they were still planning to buy, say, $20 or $40 billion per month in perpetuity. It's not our expectation. So,
Jan, I guess I'm kind of struggling with the idea that the Federal Reserve is buying more than $1 trillion a year in its base case for continuing monetary accommodation as it currently is laid out. Its balance sheet currently almost $8 trillion. It removes this accommodation. Do you really see that it's feasible for it to do so without disrupting financial markets in a way that stymies its effort to ever raise rates?
I think there could certainly be some hiccups, especially if you're also seeing a slowdown in growth next year that's driven by the removal of some of the fiscal support. I do think that 2022 is going to be substantially slower on a fourth quarter to fourth quarter basis. We think basically 2.5% after a real banner year of 7.7% Q4 to Q4 in 2021. And so if that interacts with an environment in which the Fed is tapering bond purchases, I think that could result in a growth scare. Yes, I do think we probably are going to have some nervousness in that environment.
Well, let's talk a little bit more about some of the fiscal policies here, Jan, because, obviously there's a multi-trillion-dollar proposal down in Washington sitting on someone's desk. It may not go anywhere, or it may end up being a lot smaller than, of course, what the president proposed. But I'm wondering how much of that has to factor in right now to the glide path that the Fed is trying to chart out here.
So I think the baseline should be that something gets passed, maybe not the whole thing, but something large in terms of the headline number. But I think the key point is that this is a very different type of spending program relative to the American Rescue Plan Act. That was very front-loaded, $1.9 trillion, basically over a year or a little over a year, whereas this plan is going to be over 10 years. So whatever number you see, right, you have to divide them by 10. And that's still going to mean a significant amount of fiscal drag in 2022.
Right, that's a great point. It also means, of course, there's still got to be some additional Treasury issuance. It does mean, of course, there's a potential here for changes in tax policy as well. Jan, how do you factor that in?
I think that strengthens that point, that it's not going to be as stimulative, because, as you say, a significant part of the spending increase is going to be offset by tax increases. And, I think it'll be somewhat stimulative, but, much less so than the headline number, both because of the 10-year horizon and because of the tax increases.
On Bloomberg Radio, on Bloomberg Television Worldwide, Jan Hatzius with us with Goldman Sachs, our chief economist and head of investment research on this day before an important Fed meeting. Jan, your statistic there on the slowing of the American economy under 3% is really, really important. I would suggest a huge body of Americans are not prepared for that. If we slow from a boom to a Hatzius under 3% economy, we've never done that before. I mean, you and I remember we've studied the 50s, the early 50s deflation. Do you anticipate such a shock there in GDP dynamics that we could get to a deflationary dynamic that Eisenhower knew?
I don't view it so negatively. I mean, right now we're still a long ways away from full employment. There's still a lot of slack in the labor market, despite the near-term labor supply issues, and strong growth this year is going to get us to something like full employment by 2022. At that point, you want to see slower growth, because otherwise the economy is going to overheat. Mm-hmm. You do have to worry a lot more about persistent inflation, and ultimately that's not going to be a good environment. So I think you'll need to see a slowdown. I don't worry about deflation, but at the same time, I think the current inflation is probably largely transitory.
And so much as a new economy and the overlay of technology on it, we partition it into goods dynamics inflation and service dynamic inflation. Parse the difference now as we look at a service sector dominant and goods producing as well, those inflation dynamics for our inflation expectations.
Well, I think the surprise in 2021 really has been on the goods side. The acceleration in COVID-sensitive sectors, that was very much expected. The base effects were very much expected. I think 6 months ago, most economists would have been really surprised with the enormous surge in used car prices and other durable goods like that. And that's really been the key driver. They are outliers relative to the overall distribution of prices. Core PCE is above 3%, probably will be above 3% for most of the rest of the year. But if you look at trimmed mean measures or median measures that really capture more the distribution of prices, those are still pretty well behaved. So to me, that screams transitory.
What about wages, though? Wages have been going up in particular sectors that have been more in demand, especially with the reopening. How sticky is that?
Well, I think we've seen wage increases, especially at the bottom end of the pay scale, leisure and hospitality in particular. I think the evidence suggests that the remaining COVID effects around fear of the pandemic and maybe some childcare issues, but also the $300 unemployment top-up have weighed on labor supply. That's going to be true probably for a few months longer. But in the fall, I think we'll see a big increase in labor supply. And I think that's also probably going to lead to reduced wage increases in some of these sectors.
Jan, we got a headline that the Fed's Jay Powell is planning to discuss the pandemic emergency lending program as well as the economic recovery at a House hearing on June 22nd. I am wondering about how concerned you are about the increasingly political nature of the Federal Reserve, not saying that they are political, but that they're getting increasing pressure to be political to finance the U.S. debt and deficit, especially as the U.S. plans to increase its deficit by so much.
I think there's always been political pressure and congressional oversight and, obviously jawboning of Fed officials. I mean, if you go back to President Trump, there was a lot more overt pressure on the Fed than what we're seeing now. I think now we're more in a more normal historical environment where there was always hearings like this and strong opinions expressed. But in the end, I think the Fed is committed to the mandate, and the mandate obviously looks somewhat different now after the changes of last summer. But I don't think it's dramatically different from where we've been over the long term.
But to Lisa's point as well, though, sort of the shift in that mandate, or at least the tweaking of it, does sort of open the door for greater criticism here. As much as the Fed will, of course, try to remain independent and preserve the perceptions of independence here, does the political landscape shift enough here, Jan, where maybe that undermines some of the messaging?
Look, I think the way that the mandate is being interpreted looks a little different. I think for good reasons, it does make sense to try to average 2%. I don't think 1.7%, which was the average before, is dramatically different from 2%. So I don't think it's a massive shift. But I do think that the changes that took place last summer at Jackson Hole, do make sense. Is that going to be something that will, maybe raise more questions, and including questions from policymakers and from elected officials? Probably, but I do think the mandate is reasonably clear, and we should over time find out more about exactly how it gets interpreted.